Everybody stand back. We had another crazy day in the stock market and I'm going to do analysis on it. This video comes in two parts. Part 1, hit that subscribe button. Part 2, the show. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks broadly gained, but not without some hiccups. Today we saw very interesting price momentum. Trump trades took hold, financials were the leaders, technology were the laggards, and last week's price momentum continued into today. We saw Trump heavy trades, stuff like Tesla was up 7%. This is on the back of a 30% gain last week to clear the $1 trillion market cap, and Tesla having its highest close in over 2 years. And this is just really over optimism about Musk's and Trump relationship as he enters into the Oval Office. We also saw Bitcoin hit a record high. It was up 8% today. It actually did clear the 87,000 mark. Very, very strong momentum in crypto. And not just Bitcoin, Dogecoin, altcoins, and other similar currencies also gained. And traders are pretty much betting on Trump's promise to make US a leading light in crypto. And that optimism helped push crypto-related stocks higher. Stuff like Coinbase was up 20% today. Crazy. Robinhood was up 7% and at one point 10%. And that's what we really saw today. Trump trades leading and defensives lagging, except for technology. XLK was down 0.57%, led by the overall semiconductor space. But then we saw stuff like XLP, XLRE, XLV, just essentially defensive sectors. They weighed on the overall market, with the S&P 500 returning pretty much flat today, up ever so slightly. And the real winners, XLU, XLC, XLE, XLI, XLF, XLY. These are Trump heavy trades, the discretionary space, the financial space, the industrial space, the energy sector. These are Trump heavy trades that'll outperform in a Trump administration. And we just see a continuation of last week's price momentum. And we saw that actually in small caps too. Small caps, higher beta, really making a move today. And that's because there's a ton of regional banks, smaller industrials, smaller stock names that'll benefit from Trump's tax cuts as well as overall deregulation. In fact, small cap value, small cap core, and small cap growth were the best performers amongst value, core, and growth today. Small caps really outperformed, really putting the cherry on the cake today. But mid caps also showing some relative strength relative to large caps. And then we saw large growth, large core down to flat, and then large cap value up 0.3% here today. So all in all, we're seeing very solid momentum broadly in the broad US market, especially in large caps. As you can see, technology down, the rest of the market up, and we're seeing that further momentum in smalls and mids as too. So the broadening continues, and that's really what's actually pushing the market up right now. And if we do actually see participation in these tech names, I mean, we could really go higher. And so we are seeing that churn, which is a really good thing for the market. But when you look at it in aggregate, this is the S&P 1500, average stocks above their said moving average. And we can see broadly 67% across the board from 5-day all the way to the 100-day moving average. Shorter term trends, medium term trends intact, longer term trends also intact. And all in all, the market is looking very, very constructive from where I stand, and you can't say anything different. The path of least resistance right now is higher. However, there are some very clear risks to this market that can come to bite us if it continues, and one of them is actually yields. The 2-year yield, 10-year yield, and 30-year yield continue to rally. The 10-year yield now at 4.3%. Guys, this was at 3.7, 3.75% just 6 weeks ago, and as a result, the dollar is gaining as well. And again, that is the Trump trade. A higher deficit and stronger economic growth means yields are going to rise, and stronger domestic policy means the dollar is going to rise. And that's why we're seeing this type of price momentum. And as a result, bonds did sell off today. Bitcoin up 9%, up here at the 87,000 mark. Absolutely crazy. I think we see 100,000 Bitcoin sometime in early 2025. And then because of the sharp rise in the dollar, gold fell, silver fell, crude fell. Commodities, not the place to be. Where you really want to be is in equities, particularly small caps. The IWM was up 1.5% today, mid caps 0.86%, the SP 600 up as much as the Russell 2000, and the RSP up half a percentage point, but also up here in the after hours. Very constructive price action. We are continuing to see bullish price momentum here in the after hours across all of these names. And then the S&P 500 and Nasdaq were pretty much flat today. Nasdaq fell ever so slightly, S&P 500 gained ever so slightly. Net, the S&P 500 closed at the 6,001 level, and I believe that's its first 6,000 close ever. Very, very historic stuff. Absolutely crazy. You know, at the start of the year, guys, this is a year-to-date chart, we were sitting just below the 5,000 mark. So insane to think about the price momentum we've seen in this market. Now, looking at the S&P 500, and guys, on a percentage return base, year-to-date, the S&P 500 up 26%. Absolutely wild. This is actually a crazier year than we saw last year, and that's really saying something, because last year was an incredible year in the S&P 500, and this year so far been an even better year, but it has been a crazy year. Guys, we also saw continued momentum upward in the gamma flip zones for the S&P 500. The core resistance moved ever so slightly up to the 60-20 level. So too did the gamma flip. The put support stayed where it is, and again, I still see more downside momentum here. The gamma flip didn't move up significantly like it normally does when we break, so the market is probably going to trade sideways at this level right here. And I do think that if we do pull back to the gamma flip zone, that's where you want to be a buyer. But right now, guys, you know, I'm seeing asymmetrical downside. Now, I'm not saying we're going to short or fall out of here. We can definitely go higher and break it. I'm just telling you the trade plan according to my data and my models. Looking at the Nasdaq 100, this is very interesting. Now, I'm not sure a lot. For those of you that watched last week, we saw a bit of a data anomaly where the Nasdaq 100's core resistance was like at 24,000. Today, we actually got another move up to the 20,022 level. So I don't know if this is another data anomaly or if there is something really weird happening in the options market with margin debt or something along those lines. But we saw a huge move up in the core resistance for the Nasdaq 100. The gamma flip moved up as well to the 20, 50, 60 zone. So technically speaking, you want to buy dip, sell rips to the 22,000 level. But we'll see what that looks like tomorrow. Probably just a little bit of a data anomaly, just with the processing of information that I get in the options market. And then we look at the RTY, right, guys? The RTY, at least the futures, were up 1.59% today. Absolutely wild day here, and we are a stone's throw away from all-time highs. I believe if we go on the monthly chart, yep, the all-time high right here is pretty much 24.65. We are probably breaking all-time highs tomorrow if the market believes we're going to get there. I mean, if we can take a measured move like a 0.77% move higher tomorrow, and we are making a wick all-time high, we'll see if we close there. But on the monthly chart right now, I know the month's not closed, we are looking at new all-time closing highs for the IWM, for the Russell 2000. It is wild to actually say this, but this is where we are right now, and there is a little bit of upside here for the IWM. I think we're going to go get all-time highs. I think the market wants all-time closing highs for the Russell 2000, so I would bet on that sometime this week. I think the Trump heavy trades are going to continue, and that means you probably want to be positioned in the broader market, the RSP, mid caps, small caps, maybe even a little bit of crypto. You want to stay out of bonds, you want to stay out of commodities for now. I do think the commodity trade will come back, but you want to stay out of bonds, stay out of commodities, get into equities and higher betas where you really want to be over the next couple of weeks. And I do think this is going to fade come middle of January, but we are in the Q4 rally. The Q4 rally has taken off in the S&P 500. If we just hop to the daily chart, this is the Q4 rally, guys. This is the Q4 rally. We had a little bit of a pullback here. Okay, Q4 started around here, and this is the Q4 rally. We are literally having the Q4 rally. So do expect in all of these indices, the Nasdaq 100, the IWM, everything, do expect a little bit of sideways momentum, maybe even to downward momentum. Then we're going to find a bottom late November, right, guys? And then we're going to go up from there. But if we do go higher, remember, we are already positioned, and we do just want to hold what is a seasonally great period. And there's a ton of tailwinds in the market right now. Everything from buybacks to the election, the FOMC, almost everything is a tailwind for equities. And you want to hold equities, and you want to buy any dips that we do get, because I do think we're going higher. I think we see 6,100 before the end of the year. We've just closed at the 6,000 level and onward and upward, but not without some volatility. With higher beta outperformance comes a lot of volatility, guys. And when you see stuff like coin up 20% on the day, right, that means like when they pull back, they're going to pull back 5, 6, 7, 8, 9, 10%. Higher upside beta comes with higher downside beta. Volatility is the price we pay for outperformance. Okay, guys, with that being said, when looking at the S&P 500, any dips we do get from now up until mid-January, you want to buy those because I do believe we're going higher. And I've been saying this for a very long time. I've been saying this since the third quarter that we're waiting for an end of year rally. And that's why these opportunities were absolute gifts. I always said to buy the dip and look at where we are right now. Absolute outperformance. We are going to go higher. Most of the move is done, guys. Most of the move is done. If you weren't in right here, right here, right here, or at the start of the year, you really did miss out on what is a great year of gains. Most of the move is done, but we're going to squeeze out those last little bit of gains into December, into January, and then we're going to talk about material downside in the market, and there will be material downside too next year. I'm still bullish on 2026. I'm just saying I'll let you know when we start taking profits, and we need to start talking about that. However, plan right now still to remain long, guys. Trend. So don't fight the trend. Now let's talk about seasonality. And guys, we are officially in the best 2 months of the year. November and December in election years see very, very strong returns. 2% average returns in November, 1.3% in December, and the hit rates are very, very strong. And this is in contrast to the months of September and October, where we actually see lackluster returns, negative returns in election years, and very poor hit rates respectively. So we are in very bullish months, and that means you should expect bullish price action, but it's not a straight line up. And while we do see bullish momentum in the early parts of November, we do tend to see consolidation in the middle part, where we then put in a bottom stuck at the 20 and 21st. After we put in this bottom, we go ahead and actually rally into the end of November, breaking the previous highs for an average return of 1.8%. And the tailwind often supporting seasonality in November is the 10-year yield. And guys, the momentum we are seeing in yield is actually seasonally normal. We see yields rise into the middle of the month, and then from the 9th, 10th, pretty much where we'll open on Monday, we see lower lows, lower highs into the end of the month, normally finishing in a low, and the 10-year yield sees declines of 0.3% in the month of November. So this can cause volatility. That sideways momentum we normally see in November, that is actually caused by yields rising in the early part of November. Then the bullish momentum we get towards the end of November, that tailwind is actually the 10-year yield falling. Yields and stocks normally have an inverse relationship, and that results in stocks going higher. And something very interesting we've seen, guys, is the Destiny Tech 100 ETF, ticker symbol DXYZ, was up 51% on Friday, up 223% for the last 5 days. Now, this fund is designed to be an exchange-listed portfolio of the top 100 high-growth tech companies. As of right now, it invests in 22 companies, including private unicorns, SpaceX, OpenAI, Epic Games, and Boom Supersonic. In other words, it's extremely high beta. And what does that tell you about risk appetite right now? It's extremely euphoric. This isn't a reason to get bearish. This is a reason to get ever more so bullish. And sentiment is signaling very much the same thing. Goldman Sachs Sentiment Indicator, which measures investor positioning amongst retail, institutional, and foreign investors, shot up significantly to the 1.7%, breaking the stretch positioning mark and the highest level we've seen since early 2024 here in March. Very, very bullish positioning. This type of momentum is called a breadth thrust, and when you get these, it normally signifies near-term consolidation, but the longer-term trend is intact. As you can see right here in March, we did get near-term consolidation, but the longer-term trend is higher. So guys, a lot of market signals right now: risk appetite, seasonality, the 10-year yield, sentiment is telling us we are poised to go higher, not without some consolidation, but the path of least resistance is higher. The fundamental picture also supports that. S&P 500 third quarter EPS growth currently sits at 8%. The expectation at the start of earnings season was very close to 3%. This is Goldman's data. My data is closer to 4.3% was the expectation, but we got 8% earnings growth, and things are only set to get better. In the fourth quarter, we're looking at 9% earnings growth expectations, 12% in the first and second quarter of 2025, and then 16 and 17% EPS growth in the back half of 2025. And guys, consensus EPS revisions have also been very bullish. Now, do take into consideration we see an average consensus revision of about 8% leading up into earnings season. The Magnificent Seven have seen up revisions of 17%. The S&P 500 has seen revisions of about 0. That's bullish. Even though it says 0, that's very, very bullish. And the 493 have seen downward revisions of -3%. That's also bullish. The consensus, guys, is -8%. That's what we see on average, and the market as a result would return 10% from that. So to see these type of earnings revisions are very, very bullish. But let's dive into the weeds. And S&P 500 third quarter sales, margins, and EPS is looking very robust. Com services on the market cap basis showing the most earnings growth, 22%. But when you break it down into the equal weight segment, you only see 6% earnings growth. In other words, Meta and Google really just holding this sector together. A lot different on the information technology front, 20% EPS growth on the cap weighted, equal weighted 24% growth. Guys, margins looking very robust at 24.8%. Extremely strong margins. So the tech sector growth we're seeing is actually broad based, but the com services growth we're seeing is very concentrated. And this bodes really well for the market momentum we're seeing. And then when we dive into other sectors like discretionary and financials and healthcare, we see the S&P 500 cap weighted and equal weight earnings are very, very similar. All in all, S&P 500 earnings looking at 8% on the market cap weighted, excluding financials and utilities, 5% for equal weight, and margins coming in at 11.7%. That's a 24 basis point increase year over year. That's very strong earnings. And even on an equal weight basis, this quarter, we're seeing 6% earnings growth in the median stock. That's exactly what you want to see, guys. We're seeing broad-based earnings growth, and you can't really fault the market for that. Looking at the Magnificent Seven, now Apple seeing the least growth out of all of them. Nvidia seeing the most growth in terms of revenue. The same is true here for earnings, and these companies are reporting blockbuster earnings. Sales growth of 15% for 2024, 33% in earnings growth, and the expectation for 2025 is 13% revenue growth, 17% earnings growth, and then 12 and 15% sales and earnings growth for 2026. So guys, these stocks, these Magnificent Seven stocks, these tech stocks, you want exposure to them because they are going to report earnings and revenue growth double digits into 2026. They're outpacing the broad market in terms of earnings, and the margins are expanding. And when earnings are growing, margins are expanding, stocks do very, very well. And to also just own the leaders when they're doing that, you know you'll get outsized returns, relatively speaking. And yes, we may have near-term digestion, but long-term into 2025-26, these stocks will move higher into 25-26. And diving into the macro, this is the 10-year break-even inflation rate. And for all of the movement we've seen in the markets lately, break-evens, yes, have peaked up a little bit, but we're still well below the 2.5% mark, which is where break-evens really get worrisome. And we haven't seen that big of a move in the break-even inflation rate. And this is the 10-year break-even inflation rate. So all of the momentum we're seeing is very, very healthy. And this tells us that disinflation is on the way. And the reason why we've seen break-evens edge up ever so slightly is the market repricing a whole bunch of things. Ever since Trump's election victory, the Fed Fund futures curve has moved up significantly. We were looking at a 2.8% Fed funds by December 2025, pretty much 12 to 14 months from now. That number is now sitting at 3.7% because Trump as a whole means a bigger deficit and structurally higher inflation, and rates do need to reflect that. And that's why we have seen a little bit of a perk up here in yields. But I did think this bigger move had to actually do with pricing in an overall Trump victory. Nonetheless, break-evens are rising, but still below the 2.5% level, which is still roughly tame, and the yield complex is doing what it needs to do do to reflect this. At the same time, we're seeing Chapter 11 bankruptcies trending up, but still historically low, all things considered, and credit spreads continue to remain secularly tight. And even though we have seen a move up in yields, credit spreads are still tight, and until we actually see an explosion in credit spreads to the upside, like we did here in 2020, like we did in 2014, like we did in 2008, do expect the market to continue moving higher because the economic data is very, very strong. This is the US Economic Surprise Index, and economic conditions are not just improving, they're well above analyst expectations, above the zero line right here, which boosts investor sentiment, confidence, and as a result, this drives growth in overall financial markets and equity markets as well. And this is a big reason why we've seen the move up in yields, and it's also a big reason why credit spreads and the macro have remained very resilient. And then looking at earnings on Tuesday, we have Shopify, Plug, Home Depot, C, Hertz before the open. After the open, we have Marathon Digital, Kava, Spotify, Oxy, as well as SoundHound. Those are the big names on Tuesday. And then for the rest of the week, in terms of the data, there's not much on Monday and Tuesday, but Wednesday we get CPI, core, and headline. Then Thursday we get PPI, guys, and then Friday we get retail sales. Now the consensus expectation for the core inflation month over month is 0.3, and then the headline figure is 0.2. So we really want to come in between these levels right here. And then the core inflation rate year over year is for 3.3% and 2.6%. So we really want to see inflation continue to trend down. That's disinflation. We don't really want a hot number because we got a hot number last month. We want an inline inflation print of 0.3 month over month, 0.2 month over month for core and headline. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.